Welcome to Holistic Accountant Podcast, where we aim to showcase how adopting a holistic approach in accounting and tax maximizes value for clients. Beyond traditional tasks like preparing financial statements and tax returns, a holistic accountant focuses on offering advice that maximizes personal wealth on an after-tax basis. If you enjoy this episode, please consider leaving a rating and sharing it with those who might also benefit. And to ensure you stay updated, subscribe to our weekly email. The link is in the show notes. Okay, in my other podcast, Investopoly, a few months ago, I recorded an episode about property spruikers. And the idea behind that was to just highlight sort of property fads or trends and, just to help people, I guess, avoid being or falling foul to bad advice or salespeople. Anyway, in that podcast, I spoke about, one of the more recent trends over the last number of years that we've come across is buyer's agents selling development opportunities. And, it sounds sexy. It sounds like anything that suggests that you can make some quick money is always going to be attractive to a certain cohort of the population. And that's very much their business model. Unfortunately, though, it hasn't always worked out. And Mena and I could list a whole bunch of clients. Unfortunately, they haven't sought our advice on this, but have fallen foul to this. And as a result, they've ended up buying properties that actually aren't economically viable from a development perspective, but they've paid a premium thinking they are. And as a result, they've got to exit those investments. And, the financial loss is considerable. I mean, we could be talking about $100,000, $200,000, could be more. And then when you add the transactional costs, the opportunity cost and all that sort of stuff, it's an expensive mistake. So what I wanted to do today is put it all back on Mena and interview Mena about small-scale property development. So, Mena, let's define that small-scale property developments. What, to your mind, what does that include?
From my perspective, a small-scale development will be anything that's between sort of 2 to 4 dwellings and sub $5 million sort of development build. That includes sort of your acquisition costs, your planning, and your construction costs.
And, in your experience, who should be involved in this? I mean, it's a little bit different. I talk about, ways to build wealth. There's really three ways: pure investing, speculation, and business. And, in Investopoly, I talk very much just about the pure investing, which is a very passive way to build wealth. But development kind of bleeds over to both of those, some investing, but also some sort of business as well. If you think about the sort of characteristics or, the types of people that really suits, what do you think?
From my perspective, property development is not an investment like you've sort of highlighted. Property development is a business of sort of buying and developing and selling stock. So from my perspective, the people that should be doing it are the ones that sort of have or somewhat have a little bit of business acumen and who seek the right advice from the people around them. So, you need a good holistic accountant who will look at the site, who understands property development, who knows what the actual costs are, allows you to run a feasibility to give you best and worst case scenarios, allowing for contingencies. You really need a good broker in place as well who understands how to navigate these transactions with banks. They're not a standard transaction that you can sort of just go to a major bank or a second tier bank and try to navigate yourself. And they're quite complicated to present to banks. And they can be quite costly if you choose the wrong bank as well. So it's really important to choose the right advisors around you who have the knowledge prerequisites and possibly have dabbled in it themselves.
One of the benefits of passive investing, Mena, is that you make investment once and returns compound over many years. So the idea is you're making money while you sleep. But a business is a bit different in that it does require some personal exertion and it's not necessarily repetitive. I mean, every development you do, you make a profit, but then you got to find the next development. So to your mind, how does it fit into, or how could it fit into someone's personal investment strategy?
So I think it shouldn't be a standalone investment strategy. So if you think that you're going to just be able to scale your property development operations without thinking that you should have another sort of passive income or investment strategy, I think you'll be in for a surprise, because any point in time you're going to be capped with these small scale developments. They're really tied back into your serviceability and also tied into the capital that you can raise. So for example, if I was to use an example of $1 million property that you're going to build 4 units on, and let's hypothetically say that the gross realization is $3.8 million. The capital required under a commercial lend wouldn't be any less than $800,000 to $1 million. So for you to get that kind of scale and repetitiveness to sort of expand your business operations, you need a whole lot of capital. And that's a whole lot of capital put at risk because a lot can go wrong in a development and you could sort of fall short very, very quickly. So it's really important to sort of cast your net out wide, ensure that you have investments outside of this property development, and ensure that it's not your main business. From what I tell my clients, it's something that creates somewhat of a passive income stream from your business, but you shouldn't be putting all your eggs in it, and it shouldn't take your attention away from what puts your bread on the table.
So essentially, you got to keep your day job, Mena, and it's just a bit of a side hustle.
Yeah, that's exactly right.
Okay, great. And what about, are there any sort of particular market conditions or property types that make this strategy more attractive at times?
Yeah, definitely. I generally sort of advise clients to have or look at property opportunity will sell for sub $1 million. So the townhouses, once they're developed, or the units, once they're developed, they're sub $1 million. And the units in areas that allow for certain amenities, are they close to train stations? Are they close to daycares, schools, and so forth? Because these have the greatest sellability. There's a lot of people out there, and especially in the sort of lower socioeconomic areas, that are just happy to be in one of those properties, to have a property or home that they can call their own rather than rent, and they're less picky about the product itself.
Okay, great. So if let's say we're going to build 3 townhouses, we want it to be less than $1 million. So let's say 3 at 900,000 is the end value. I guess I can then reverse engineer what I need to buy the land for after, I do a bit of a feasibility analysis. And if that says, let's say I need to buy a block of land for $800,000 or something like that to make that deal work, how do I go about finding the locations where that, in terms of where should I be looking for that land?
Yeah, the first thing I would actually do before going down the location path is making sure that you've engaged the right architect, because an architect that has actually sort of dabbled in these small scale developments and understands the town planning requirements around certain areas. Now, I often tell clients to sort of use draftspersons or architects who have already done sort of planning processes within particular councils already. So they tend to know what the planners look for, what councils really push for and so forth. So once you've sort of got that team behind you, then you'll sort of start approaching agents and understanding what to look for. So the architect will tell you, okay, to build 3 townhouses, for example, in this particular site might be a site that, for example, is under an airport overlay. So you need 300 square meters per townhouse as an example. So you'd need to go out and search for a block of land in that particular sort of suburb that is 900 square meters or 900 square meters plus. So there's a lot of things, a lot of intricacies that come into play with certain councils and certain sites within that council. So, the zoning changes, you could be a GRZ1 or a GRZ2 that restricts how close units can be and how big the units can be. So it's really important to ensure that you've got the right team behind you before you consider the suburb and location.
Awesome. So, okay, let's say we've done that. We've gone out, we've identified a particular location, we've found a 900 square meter block with maybe a dwelling on it, an old dwelling on it. What are some of the checks that we need to do now, Mena?
So the first check would be approach your architect, make sure that the orientation is correct. They'll do all their checks. I'm not an architect myself, so I'll be amiss to sort of advise on what they actually do. But they'll look into the site and the parameters, check the contract of sale as well to check that you can actually achieve the 3 dwellings. Then once they've done their checks and given you, the go ahead, they'll then tell you what can be achieved in terms of sizing of dwellings. Once you have the sizing of dwellings, you then know, okay, roughly what it will cost you to build. Now, the big mistake a lot of people do is they don't factor in a contingency here. So when you do, people will say, yeah, it costs 20 grand to build, 20 grand by 20 squares, it's $400,000 build. It's quite easy math. Nothing can go wrong here. Whereas a lot can go wrong. A council during your civil design stage, for example, might ask you to do an outfall drain or something like that, there goes another 40, 50 odd thousand. So it's really important to have a contingency in place and run a feasibility with your holistic accountant, because the holistic accountant will walk through the best and worst case scenarios with you. Then you'd obviously need to approach a local agent to establish what your gross realization value is. How much are these townhouses actually worth? Now, a lot of people make the mistake of thinking, okay, by the time I get my DA and build, we're talking about a 2-year time frame here. The property market will be very different in 2 years. Let's bank on an uplift in those 2 years just so that we can make these numbers look good. That's the biggest mistake you can make, in my opinion.
So what are some of the red flags in terms of issues that if you do a feasibility that you'd walk away from? So is it really just about, the site not generating enough money? Is that the key thing to look at? And also, Mena, what are we looking for? Are we looking for a 15, 20% return? What's your idea there?
So when it comes to return, I'm a bit conscious of putting certain numbers out there because a lot of people calculate returns very differently, as you would know, Stuart, in sort of financial planning. So, for example, a lot of people wouldn't factor in the margin scheme and the GST components and so forth, and just look at a return on capital perspective, which I don't think is the right way to look at the return because at the end of the day, yes, you could double your money on the capital that you've put in, but you've used a lot of bank capital to fund the rest of it. And if something was to go wrong, then the bank's not going to say it's okay. So it's really important to sort of understand what could go wrong and do the checks before you do anything. So the feasibility, from my perspective, after factoring in margin scheme, GST, taxes, and so forth, should not yield you less than a 15% return, and I say a 10% return on a low case model.
Yeah, okay. So if we're buying for, $1 million and then spending 1.5, or the gross realization is say 3 million, we're essentially walking away with 450,000 in terms of profit.
Yeah, that's right, give or take.
Yeah. Okay, great. And that gives people a sense of, how these sort of opportunities can work out. Okay, let's talk about financing then, because obviously we need the money to be able to buy and build these things. What are the two sort of financing options we can consider?
So the first one is residential lending. Now, when it comes to residential lending, the criteria is a lot stricter. It relies a lot more on serviceability, and banks restrict the number of dwellings that are allowed when using residential funding. So residential funding can usually go up to 3 units. Some banks you might be able to push to 4, but you can't bank on that. But it's obviously a less costly approach, but your valuation that they use for a residential lending is a lot lower than what they'll use on a commercial lend, because they take the LVR based on an inline valuation, meaning basically your development before it's subdivided. So you could end up needing to put up more capital up front, but it is a cheaper option. The second option is a commercial lend. Now, this is where you generally get anywhere between 65 to 70% of GRV. The banks may require a pre-sale or two just to sort of cover their risks in the development. And when you do that, you can actually sometimes end up with a lower interest rate than what you'll get on a residential lend. The flip side, though, is that they will charge you an establishment fee, and that can be anywhere between 0.5 up to 1.5% of the total lend. And generally, they require a quantity surveyor to inspect every sort of stage. So allow for another anywhere between 1,000 to 1,500 per site inspection, plus their initial quantity survey report, which is around $3,000.
Yeah, but all these finance costs are included in the analysis. So I guess even if we're paying higher interest rates or higher fees and we can still make money, it's better than not making money at all. So let's talk about ownership then, Mena. And, like everything in this podcast, it's information only, it's not advice. And of course, and I say that because there's always exceptions that prove every rule, so that just one rule shouldn't apply to everyone. But just generally speaking, if my goal, Mena, is to build these 3 townhouses and then sell them once they're completed, what sort of ownership structure might be more appropriate?
I will go down a corporate structure with a trust as shareholdings. Now, you would have heard from me in the podcast previously that I never like to have shareholdings individually, just to give us that flexibility to sort of distribute profits. Now, the benefit of having a company as a structure is that obviously you capitalize on the 25% tax rate, and then you can use that company to lend another company for another development when you come to do your second development.
And what about if I want to keep the 3 townhouses as sort of long-term hold, rent them out and retain them for maybe another decade or whatever?
So again, we'll need to look at the rental yield to see, what the income stream will be based on, the current lend and so forth. And we'll need to look at the depreciation schedule as well. So if you're looking to hold them, we might look at owning it individually. It's a bit unlikely that we would, but the depreciation benefits might be that high for a number of years that we would consider holding it personally. Alternatively, we might look at a trust structure if it's likely to be positively rental income stream in a very short time frame.
So I guess, Mena, logically, your borrowing capacity is really going to be able to dictate your ability to firstly invest in something like this, or, do a development, and then to what extent, as Mena suggested, the two options being residential finance, commercial. The other challenge with residential finance is that you have to qualify for the full debt. So if you're buying some land for $1 million and there's another $1.5 million of costs, well, you've got to have enough borrowing capacity to be able to service $2.5 million of debt. I don't think we need to get too caught up in it, though. At the end of the day, it's a transaction, and it's really about just getting access to that finance rather than necessarily, the cost isn't that significant. It's not like a typical finance that you're going to have for many years. It's in and out, really. Okay, man, let's talk about just some of the practical kind of process to manage a project. Typically, how long are we talking about from start to end?
I usually say, how long is a piece of string as as an answer, but typically you're in council roughly anywhere between 6 to 12 months for the initial DA. And in the construction phase, again, depending on your builder and how large the development is, it's another roughly 12 to 18 months.
And what about time commitment? Are there particular phases of the development cycle that are more time consuming from an owner's perspective? And what sort of time commitment am I up for?
I would argue that if there is a time commitment, you shouldn't be doing it because, like I said, it shouldn't take away from your day job. It's a business that you engage the right personnel from the get-go, so you don't require a whole bunch of time. Now, saying that, you still need to take ownership of the business and ensure that, that the people that you've employed are doing the right things and hold them accountable for what they're doing. But from my perspective, after the design stage, in terms of what you think is the right design, in terms of floor plan and so forth, there shouldn't be much more of a time commitment other than dealing with your broker and providing the required documents. And if you've got a builder in place, just making sure that you've got the right contract in place with the right time frames and just making sure that you're managing their stage payments and ensuring that they're actually doing what they say they're doing at each and every stage.
Of course, the key thing is getting the right site and it being economical to develop. So we wouldn't buy it unless that was the case. And, whereas if you buy a site that's going to be a complete dud, of course, there's nothing you can magically do after the fact. So assuming we've got the right site and we've got the right approach, what are some of the things that could potentially go wrong during that construction process?
So one of the things that I sort of touched on before is around, for example, your outfall drains or things that, they don't really get across until it's sort of at a particular stage in terms of in the construction. So, another one will be, for example, the initial excavation. There might be rocks underneath where you're sort of building and that's not really factored into the build and no one really knew about it. So, there needs to be an allowance for that. So like I said, it's really important to have a sort of a sundry allowance for each and every expense. And I'm not only talking about construction here. There needs to be a sundry allowance for your architectural sort of planning fees, your engineering and so forth, because you might need to go back to them after something's been found on site where, something needs to be redesigned. They need to adapt and they're not going to do that work for free. They're going to charge for it. So it's really important to have the right contingencies in place for each and every step so that there's no surprises.
If someone's just starting out, they haven't done a small scale development before, but they're interested in getting involved, what do you recommend as kind of the first port of call? Or maybe there's a bunch of tips that you can give.
I'm a bit wary of, based on prior experience, of engaging a buyer's advocate when it comes to development sites. Unfortunately, there's, as Stuart sort of touched on before, there's a lot of property spruikers out there who would sell something as a development site. And we've seen it a lot with current clients, unfortunately, where they've been sold a promise and it's just fallen short. It wasn't never going to be economical to develop. So I think the first point of call is making sure that you've engaged a holistic accountant who understands development and can walk you through the pros and cons and the numbers behind it.
Mark Cuban is famous for saying never take advice from someone that doesn't have to live with the consequences. So look, I think getting some independent advice here. So again, we've got a vested interest to say it, of course, but a holistic accountant that, doesn't really care whether you're going to do a development or not. They've got no vested interest there. They're completely independent and they can make sure that it financially stacks up. And I think that is easily the safest way to avoid making a mistake, because even if you add all the contingencies in, and even if those contingencies materialize in terms of the cost being more than you expected, and you still walk away with a 15% profit, look, you've done pretty well. And I don't think anyone's going to be upset with respect to that. So thanks very much, Mena. It's been really interesting, a good sort of very quick introduction to small scale property developing. And of course, if anyone's interested, they can always reach out to us via the podcast. And until next week, bye for now.